Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. Thank you so much for joining. If you have questions or topics you wish to discuss, please chat those over now so that we can be sure to get to them all. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So again, welcome to your daily Solo 401k webinar and Q&A session with My Solo 401k Financial, where we're here to help you stop overpaying taxes and start building real retirement wealth. Today's topic, advisor-friendly Solo 401k, a full-featured plan, but open custody, so no platform lock-in. Again, this is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. Let's get started. So we want to start out with the questions that have been chatted up, what we got going. First one is from Devon. What's your total annual cost for? So we charge, first of all, 100% flat fee. So it's not based on the value of the account. It's not based on the support needed. So it's $650 is the initial cost, which includes the $525 establishment fee plus the first $125 annual fee. And then starting 12 months later, we charge our $125 annual fee that covers the second year. So setting up the plan will make the self-employed business eligible to claim $1,500 in solo 401k tax credits. So that's a dollar for dollar reduction in the individual's tax liability. So that's going to more than cover our fees for the first 7 years. So it's certainly noteworthy. Now, we are acting as the plan provider, and that's one of the topics we're going to discuss today and why we're so compatible and complementary to advisors, because we don't hold your money, we don't charge a percentage of the balance. So as the plan provider, though, we do provide plan compliance support. So for example, we're automatically going to keep the plan documents updated, because 401k plan documents, you can think of them as living things. As the law changes, the documents need to be updated. So we proactively provide the documents to the clients. Other support, though, will depend on what's going on with the plan. So for example, if someone wants to take a 401k loan, we prepare the 401k loan documents for no additional charge. Clients just simply need to request it. Other examples would be setting up accounts. So we're very hands-on in helping customers open up accounts, funding the accounts, whether it's helping them educate them on the contribution rules, helping them with rollover forms, etc. In both regards, we're helping the clients with funding the accounts. And then other examples of compliance support would include the 5500 EZ. So once the value of the plan exceeds $250,000, customers or their advisors just need to let us know, and we'll add their plan to the queue to prepare the 5500 EZ. We do that via the electronic filing system to make it easy for the customer, for the advisor, for all parties. In addition, 1099-R reporting. So a 1099-R would be needed, for example, if money is leaving the plan, for example, a taxable distribution or rolling the funds out of the plan to another retirement account like an IRA. For example, if the person is shutting it down, or if they're over age 59 and a half and they're eligible to roll the funds out, as well as if they're making a mega backdoor Roth contribution, which is one of the most popular reasons the customers set up accounts, a 1099-R will be needed as part of that mega backdoor Roth contribution. So customers or their advisors just need to submit the online form on our website after there's a transaction that requires a 1099-R, so we can add their plan to the queue to prepare the 1099-R. We do that for no additional charge. And just a follow up from Devon before we go to the next person, what's your total in cost to have this plan? So we talked about that. It's $650 is the initial cost, and then $125 starting 12 months later. And that's for the entire plan, regardless if you've got multiple participants, like a husband and wife, or multiple sub accounts, like pre-tax, Roth, and voluntary after tax, which is how you make mega backdoor Roth contributions. Again, we talked about the 5,500. and it's automatically going to allow for Roth and mega backdoor Roth contributions. And we'll talk about the deadlines, but just quickly, as long as you sign up with our plan, if you sign up for an account on our website, mysolo401k.net, by December 31st, that'll lock in the ability to make all types of contributions for 2025 by your business tax return deadline, including any time you filed extension next year. So let us know if you have any follow-up questions. Thank you for bringing those good questions, Devon. If I have multiple LLCs, assuming they're all profitable, can I contribute to a solo 401k account from all three businesses, assuming I don't go over the contribution limits? That's a great question from Mario. The answer is yes. You need to aggregate from all sources of self-employment income to determine how much you can contribute. In that case, it's one plan, one fee when you're setting it up, but you can justify those contributions based on all sources. You aggregate all sources to determine how much you can contribute. So technically, if you have one business that's losing money, that's going to reduce your total amount of self-employment income upon which you determine how much you can contribute. But if you've got positive income from all sources, you aggregate that to determine how much you can contribute. Great question from Mario. Does everyone qualify for the $1,500 tax deduction? So first of all, it's a tax credit, not a tax deduction. But yes, all you need to do is establish a solo 401k. So you need to be eligible to set up a solo 401k. That means you're reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees. And then you set up a plan with My Solo 401k Financial, because we automatically draft the plan to include the required features, the required notices that will make the self-employed person eligible to start claiming those credits. It's $500 per year for 3 consecutive years. So as long as you sign up with us by the end of the year, that'll create the plan for 2025 and enable the person to start claiming the $500 per year credit when they file their 2025 tax return. And as part of the onboarding process, we provide our clients with a link to a deep dive webinar that we hosted with an IRS enrolled agent that goes through step by step how to claim the credits. Great question from Audrey. Thank you for bringing it. Back to Devon. If I want to max out IRA deductions, I can take W-2 salary from my corporation of $186,000, which will allow me to take $30,500 employee 401k contribution and $46,000 as an employer contribution. Is that the right thinking? Can I still do the backdoor Roth on top of this with the same $186,000 income? So first of all, it's a 401k, not an IRA. Yes, your ability to contribute to the plan is based off of your self-employment compensation. So if the business is taxed as an S corp, it would be based on the W-2 wages that are received from the S corp, along with other factors like your age, whether you contribute to another plan, the type of contributions that you're looking to make. So for someone that's 50 or older, age 50 plus, and they're not 60 to 63 for 2025, they could actually contribute 100% of their W-2 wages up to $31,000, because the limit is $23,500 plus an additional $7,500 that can be made as an employee contribution. Now that assumes that they're making contributions to another plan, like a day job plan. And then on top of that, they can make an employer contribution equal to 25% of their W-2 wages. So that could go, in that case, all the way up to $77,500. But that would be the total limit. They wouldn't be able to make any other contributions on top of that. Like they wouldn't be able to make any other after-tax contributions. But if they reduce how much they contribute, for example, as an employer, then they could use that amount that they reduced it by as an after-tax. So they could diversify from a tax perspective, have some contributions made on a pre-tax basis and others made on a Roth or a voluntary after-tax basis. For a W-2 employee with a side business, can he set up a solo 401k? Absolutely, as long as they are reporting earned self-employment income and there's no W-2 employees working for that person or a spouse, if any, for any business that they own. So the fact that someone has a W-2 day job and even participates in their W-2 employer-sponsored plan won't prevent them from setting up a solo 401k for a separate side hustle, right, where they don't have any employees working for them. Great question from Timothy. Thank you for bringing it. So now let's go to the slides that we wanted to share. And again, if there's questions that come up either on these topics or other topics, please don't hesitate to chat it over so we can get a chance to address your questions or topics. So let's give us an overview of where we're headed. So we want to talk about the mysolo401k.net model as it works with advisors and why it's advisor friendly. So advisor and client eligibility. We'll talk about the open custody structure. So the difference between the plan and the account, deadlines and contributions, and also talk about the why, right? Why do clients set up accounts with us? What is the advantage for your clients? Advanced features, compliance, etc. So now let's dig in deeper. So how my Solo 401k Financial is different is that we offer an IRS approved plan with advanced features, and we also provide compliance support, kind of like we touched on with some of those initial questions. But we are neutral as far as where the accounts are at. So you're really separating the account provider from the 401k plan provider. So that means that clients and their advisors are not locked in to a platform, right? You don't have to have your accounts with us. We don't provide accounts. We don't have access to any of our customers' accounts. Our fees are not based on the value of the account. So it's very compatible, complementary to advisors, right? So advisors can provide all their great services to their clients, and then we are there to complement that by providing a powerful 401k plan that's going to be able to work with wherever they custody, as long as wherever the advisor custodies will open up accounts for a third party plan. And in our experience, virtually all do. So it's an open custody model. So the process is to first establish the plan, meaning the documents with my Solo 401k Financial, then open up accounts for that 401k plan, which is really a legal entity. So it's established by creating the documents, but then open up the accounts at the custodian of choice, wherever the advisor custodies at. So the client and or the advisor chooses the brokerage, so the advisor can maintain their platform preference. So examples of supported brokerages are going to include Altruist, Fidelity Institutional, Schwab Institutional, LPL, Edward Jones, among others. Now, who's eligible for a solo 401k? Well, solo 401ks are owner-only plans. If you look at the code, it's referred to as a one participant plan. So it's really designed for self-employed individuals, because any 401k needs to have an employer. But if you're self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any, you're eligible to set up a one participant plan, an owner-only plan. Now, there are exceptions to that one participant requirement. For example, a spouse who's working in the business can also participate in the plan, and is still considered to be a one participant plan. So it still enjoys the benefits of a solo 401k with all the advanced features, but also streamlined from a compliance perspective, which allows it to be offered very efficiently at a relatively low cost manner. So in order to be eligible, the individual needs to report earned self-employment income on their taxes. For example, if their business is taxed as an S corp or a C corp, that would be W-2 wages from the S corp or the C corp. If the business is taxed as a sole proprietorship, right, they don't even need a formal legal entity. Or maybe they have a single member LLC that's disregarded, where they report the income on their 1040. So earned self-employment income in that case would be income reported on Schedule C of their 1040. And then lastly, if they happen to be self-employed via partnership that's filing a Form 1065 partnership tax return, earned self-employment income would be income reported on line 14 of the K1 that they received from the partnership. Now, the other piece of the eligibility criteria is that there cannot be any eligible employees. So that means there can be no full-time W-2 employees who are age 21 or older working for any business owned by that person or a spouse, if any. So someone would be considered full-time if they're working 1,000 hours or more per year with a year of service, or 500 hours or more per year for 2 consecutive years. Now, I mentioned a spouse can participate, another business owner can participate, as long as that business owner is at least a 3% owner, reporting their own earned self-employment income. Like, for example, they get their own W-2, or the spouse doesn't need to be an owner of the business. The spouse just needs to be working at the business. In other words, reporting their own earned self-employment income, such as their own W-2, if the business is taxed as an S corp or a C corp. And then, as we noted, The fact that someone has a W-2 day job and they have a side self-employed business, they would still be eligible to set up a solo 401k, even if they're participating in their W-2 employer sponsored plan. Now, for purposes of setting up a plan for 2025, in order to preserve the ability to make all types of contributions for 2025 by the self-employed business tax return deadline, including any timely filed extension, the plan needs to be established by December 31st, 2025. So that is the critical deadline. Now, what does it mean to establish a plan? Well, it goes back to what a plan is. A plan is a legal entity. It's technically a retirement trust because the assets are held in trust for the benefit of the self-employed person, right? It's not an asset of the business. It's not even a personal asset that the person can use without restriction. So it's held in trust. So like any legal entity, it's the documents that create it. So in order to establish the plan, you need to focus on the paperwork first. So that's all that needs to happen by the end of the year, is to have the plan documents in place. So that means that the accounts don't need to be open by the end of the year. The EIN for the plan, so a separate EIN needs to be obtained for the plan, but that's part of the account opening process. So that likewise can happen after the end of the year. And of course, the contributions don't have to be made by the end of the year. And this is different than the rules that apply to a day job plan. So if someone has a 401k plan at their corporate job, they need to make their employee contributions by the end of the year. But the rules are different for self-employed individuals. And this is confirmed by IRS publication 560, which is the landmark guidance for self-employed retirement plans like solo 401ks, where they make it clear that as long as the plan is established by the end of the year, that preserves the ability for the solopreneur, for the self-employed person, to make all types of contributions by their business tax return deadline, including any timely filed extension the following year, right? That's confirmed, for example, on page 3 of IRS publication 560, which makes sense from a policy perspective because many solopreneurs, many self-employed individuals don't know how much they've made until after the end of the year. And of course, their ability to contribute to the plan will be a function of how much they've earned. So it makes sense that they would need more time to open up accounts, determine how much they can contribute, and decide how much they're going to contribute. So the strategy is documents first, accounts later. My solo 401k financial makes it super easy to meet the deadline because we will prepare the documents within the same business day when the client signs up. And then again, they can take their time to open accounts, fund the accounts by their 2025 business tax return deadline, including any timely filed extension in 2026. So for example, if their business is taxed as an S corp, as long as they sign up by the end of the year, that'll give them till March 16th because the 15th falls on a Sunday of 2026, or September 15th if they file a timely extension for their 1120S for their S corporation tax return, to open the accounts and make those 2025 contributions. So the role of the account provider is to simply provide the accounts. They're not providing the plan. So for example, one could go to Fidelity and get a vanilla solo 401k plan, but it's not going to allow for the advanced features. Fidelity is not going to provide the support. But at the same time, Fidelity Institutional, Schwab Institutional, of course, Altruist, LPL, etc., they will open up accounts for third-party plans, like those offered by my solo 401k financial, that come with the advanced features. So your clients can have all the advanced features, but you can still be managed wherever the advisor custody's at. So what are those advanced features? Well, some of the top use cases are the ability to make mega backdoor Roth solo 401k contributions, which is in short, for example, for 2025, where one could contribute, where the funds end up in a Roth 401k or Roth IRA up to $70,000 for 2025, or even more if they're age 50 or older. Roth conversions, so this is where you have funds that are already in a pre-tax status in a retirement account, but now you want to convert it to a Roth. So now you have the potential for tax-free growth. Solo 401k loans. So in order to be able to take a solo 401k loan, you need to have a plan document that allows it, right? Back to the vanilla plans offered by the brokerage firms that don't allow for 401k loans. So that's where the person could literally withdraw funds from their solo 401k that could then be used for any purpose. And it's not going to be considered a taxable event as long as it's within the terms of the loan. So for example, they're limited to borrowing no more than 50% of the balance, not to exceed $50,000, and then documented on a loan as documented on loan documents, which we prepare, as a service for our customers and their advisors for no additional charge. We prepare those within 1 business day when prompted to do so. We have an online form that clients and their advisors can submit to prompt us to prepare the loan documents. And then that loan will need to be paid back to the 401k according to the terms. So those terms are going to require that it's paid back in monthly or quarterly payments up to the client, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. Other features would be alternative investments. So the plan does allow, for example, investing in private placements, real estate, crypto, precious metals, just to name a few. The $1,500 in tax credits. So setting up our plan, it could be a new plan or an upgraded plan. So if someone has a basic plan, for example, at Fidelity or Schwab, that they want to upgrade to our plan to be able to take advantage of these features, they can do that. And part of that upgrade will include the auto enrollment features and notices that need to be in place that will then make the self-employed person eligible to start claiming $1,500 in tax credits. So it's $500 per year for 3 consecutive years. Now that auto enrollment feature will put in a default 3% contribution percentage, but the solo 401k owner, as the participant, has the right to opt out of that 3% default, which will then allow them to contribute in whichever schedule or amount they prefer, of course, subject to the limits and the deadlines. The fact that they exercise their right to opt out of the default doesn't mean that the plan doesn't have the auto enrollment feature enabled. It still does. So notwithstanding the fact that they opt out of the default, the business can still claim those credits. And then as part of that onboarding process, we provide a link to a deep dive webinar hosted with an IRS enrolled agent that goes through step by step how to claim the credits. And then lastly, the 5500 EZ and 1099R compliance support. So once the value of the plan, including the value of any defined benefit plan that the self-employed business might have, exceeds $250,000, there's an informational filing requirement that applies. The name of that informational tax filing is the 5500 EZ. So clients or their advisors just need to let us know once the value exceeds $250,000. Then we'll add their plan to the queue so that we can go through the process to prepare that 5500 EZ. So we, for example, have a lot of the information that's needed. We reach out to the client and the advisor to capture the financial information. We will then prepare the 5500 EZ and the electronic filing system, the EFAS system, to make it easy for the client. And we do all that for no additional charge. In addition, 1099R compliance support. So a 1099R is going to be needed in different scenarios. For example, if there's a distribution, there's money rolling out, if there's a conversion, let's say from a pre-tax status to a Roth status, as well as making a mega backdoor Roth contribution is going to require a 1099R to be issued. So customers or their advisors just need to let us know when one of those transactions occur. We have an online form that can do it very quickly and easily. That adds the plan to the queue to prepare the 1099R, which again, we do via the electronic filing system and for no additional charge. So the tax credits, we talked about that. That's going to more than cover our fees for the first 7 years. So we charge $650 as an initial fee, which includes the $525 establishment fee, plus the first $125 annual fee. Starting 12 months later, we charge our $125 annual fee. It's totally flat fee structure. So those $1,500 in tax credits will more than cover our fees for the first 7 years. The compliance support, right? For example, with the 5500 EZ, the penalties for failure to file are quite substantial, $250 a day. So having that support can be hugely instrumental in avoiding a potential high penalty situation from the IRS, just to give a simple example. And then just to highlight it, this time of year, many individuals are trying to establish a plan by the end of the year. And we make it super easy to do that because it's really just a 3-step process. They just need to submit, or the advisor submits on their behalf, our online application. Just takes a minute. Once we receive the application and payment is made, we prepare the documents that are customized specifically for that self-employed business within the same business day. And then an email goes out with a link to our secure portal. The advisor is copied. So when that application is submitted, a good tip would be to include the name and email address on the application of the advisor. So in that final field where the name of the plan is being selected, really you can choose any 2 words in the word trust. For example, Smith Wealth Trust. Then you can add additional notes, content, including, for example, please copy and then the advisor's name and email address. So that we'll copy the advisor in the communication. So within that same business day of receiving the application and payment is made, an email goes out with a link to our secure portal where the client or the advisor can download the documents that were created for the self-employed business. There's also going to be an upload link and a link to a next steps questionnaire where they let us know where they want to open up the accounts at. But you can take your time to return the completed and signed pages of the establishment docs, as well as submit that next steps questionnaire. Take your time in 2026. As long as you sign up by December 31st, 2025, now you can take your time to open up accounts, to make those contributions by the business tax return deadline, including any timely filed extension in 2026. So that's going to lock in your ability to make all types of contributions, take your time to open up the accounts, et cetera, et cetera. All right, that takes us to the end of the slides that we wanted to share. Thank you so much as we went through those slides. Now we do want to go back to the questions that have been chatted up. Thank you for bringing the questions. We do want to take a quick moment. If this information is helping you feel more confident about your future, please take 1 second to like and subscribe. Liking will tell the platform that the content is valuable, which helps other advisors, other solopreneurs like you find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. So please take 1 moment to like and subscribe, whether you're on LinkedIn or X or YouTube or Instagram. My kids are my only employees earning $15,000 each. Do I still qualify? So in order to be eligible, it needs to be an owner-only business with no non-owner, non-spouse, full-time W-2 employees. But if you have minor children who are working as W-2 employees, so they're under 21 years of age, the fact that they're working as W-2 employees won't prevent that person from being able to set up a solo 401k. Now, once the children are 21 years or older, if they're still working as W-2 employees and they're working on a full-time basis, then that would prevent the business from being able to maintain a solo 401k. So in order to preserve the ability to keep that solo 401k and still have your 21 or older children working as W-2 employees in the business, you need to make those children at least 3% owners each, so that now they're considered to be another owner of the company. It's therefore still an owner-only business. Good question from Audrey. Next question from Mario. For an S corporation looking to reduce net income in 2025, everything will need to be completed prior to December 31st, correct? Plan documents, EIN, contribution based. No, that's not correct, Mario. All you would need to do is sign up by December 31st. You could take your time to obtain the EIN number, take your time to open up the accounts, take your time to determine how much you're going to contribute. As long as you do that by your tax return deadline, so March 16th or September 15th of next year in the case of an S Corp, if you file a timely extension for the 1120S. So all you need to do is sign up by the end of the year. You don't need to take those other steps by the end of the year. Could I have multiple custodians for a solo 401k account? For example, one for equities, another for crypto, another for gold? Most certainly. And that's not uncommon because some of our customers may be investing some of their solo 401k funds, for example, in alternative investments, but others in brokerage type investments. So as long as each of those accounts are opened up under the name and EIN number of the plan, which we obtained an EIN number for the plan as part of the onboarding process, then that would be totally acceptable from a solo 401k perspective. at the current moment, is there any reason why I couldn't roll over the 401k after 3 years and start a new one to claim another $1,500 tax credit? Yes, you can only claim those credits. First of all, it's $500 per year for 3 years for a total of $1,500, but only one credit can be claimed. So you wouldn't be able to do it multiple times. Great question from Brian. So let us know if there's more questions. We do have a little bit more time. We also want to invite you to our community. We have the largest community of solopreneurs, advisors around these solo 401k topics. We've got over 30,000 members, which means we've got vibrant forums. We have a library of videos and webinars. So there's lots of ways to learn, lots of ways to share the knowledge. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. So we're totally neutral. Another good question from Brian. As far as where the accounts are at, Fidelity and Schwab happen to be the most popular options, but especially, for example, with advisors, we've got advisors at many other custodians, such as Altruist, such as LPL, Edward Jones, just to name a few. So we're totally neutral. Now, as far as Vanguard exited the solo 401k industry well over a year ago. And so they outsource to Ascensus. So they don't open up accounts for third-party plans. Now, we have many clients who upgrade their Vanguard/Ascensus plan to our plan to take advantage of these features, the service, the tax credits, etc. But you cannot have our plan documents and then open them up at Vanguard just because Vanguard makes a business decision not to open those accounts. Good question. All right. Well, it looks like that takes us to the end of the questions for today. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Thank you so much, everyone.